Hello, and welcome back to DoubleLine's Channel 11 News. I'm Ken Shinoda, your host today, Friday, November 20th. October ended with an increase in volatility that saw a multi-week sell-off of global risk assets heading into the highly anticipated 2020 U.S. election. With the election now thankfully behind us, maybe, and positive vaccine news from both Pfizer and Moderna, markets have rebounded significantly from the pre-election low, with the S&P and NASDAQ both up over 9% on the month. Yesterday's laggards are today's winners. Europe is outperforming the US. The Euro Stoxx 50 is up 16%, and Italian and Spanish bourses are up over 20% on the month. In emerging markets, with the tech-heavy Asian markets were the previous front-runners year to date, LATAM and EMEA are now outperforming on the year, up 21 and 13% respectively, versus 8% for Asia. With positive vaccine news giving hope to a broader reopening of the economy in 2021, markets now focus on the hardest hit cyclical names, and value finally outperforms growth in a meaningful way. The Russell 1000 Value Index is up 12.2% versus 8.2% for growth on the month. Energy, financials, and industrials, once the losers to the Fangmans, now shine. Are we welcoming the baby boomer stocks to the land of gains? Will this trend continue? It remains to be seen if the market is being too optimistic about the vaccine and potential future growth. With COVID cases on the rise globally, the increased potential for another round of lockdowns creates headwinds for the market. It also increases near-term demand for treasury bonds and contains long-term interest rates that started to rise in the US in the late summer, nearly hitting the critical 1% level after the election. Given the strength of the markets, the Fed remains on the sidelines, making no comments on whether they would change their bond buying program in December. Chairman Powell continues to urge policymakers in Washington to pursue additional fiscal stimulus as they expect the pace of recovery to ease compared to the strong gains seen during the summer in labor markets and consumer spending. Meanwhile, Washington continues to be at an impasse on additional fiscal stimulus, but it's expected that negotiations will accelerate over the next few weeks, consistent with statements from both Republican and Democrat leadership. A spending deal with or without new stimulus will be needed to be approved by December 11th to avoid a government shutdown. As we enter the holiday season, we can now look forward to the end of 2020, finally. All eyes turn towards the new year, fresh beginnings, and of course, the outlook for markets. We are very fortunate to have a special guest with us today, Jeffrey Gundlach, CEO, CIO, and founder of DoubleLine. I hope our viewers enjoy his insights and thoughts. Welcome to the show, Jeffrey. Well, thanks, Jeffrey, for coming in and joining us. It's been a while since we've seen each other, so it's nice to see you.
Yeah, I guess we're at 8 months.
8 months,
plus.
yeah.
Work from home.
We're finally, I guess, putting 2020 behind us. I think a lot of people are hoping 2021 is going to be a good year. It's been a crazy year with the pandemic and the big sell-off in March, and now we're hitting new highs. It's very the reality of the economy is you kind of drive around downtown or the streets with nobody out here and businesses closed, yet risk assets doing so well. People are now finally kind of concerned about, the COVID cases picking up. Maybe this fiscal plan gets pushed out. How do you feel about the possibility of a double dip recession? Nobody seems to be talking about it.
I'm not sure that we're out of the recession now. I mean, yeah, when you have the fall off in PMIs and industrial production and the rise in unemployment of the rapidity and extent that we had in March, April, of course, you're going to have a bounce back. But we're not all the way back yet. I think for me to say that we're out of recession, I would need to see a new high in GDP, meaning taking out the high of the first part of 2020. We're not close to that.
Yep.
So, the statistics that we look at every month, we used to have a high degree of context in which to consider them. And thanks to the enormity of the government response, which of course was a $3 trillion transfer payment, all the data is so distorted. I mean, our hourly earnings really rising. I mean, with the amount of unemployment that there was, it was not evenly distributed across the economic spectrum. So the lower wage jobs were lost en masse. Mm-hmm. And so you had a real mix shift in the average hourly earnings numbers. And I would suggest there's probably a bigger mix shift than most people feel to appreciate on most of the economic statistics. I'd actually zoom out even further and sort of say, are we really out of the global financial crisis? When you look back and think about unemployment, or I should say the number of jobs that was lost earlier this year took us down to pre-global financial crisis employment levels. Now, some of those have come back, but the policies that we put in place to combat the global financial crisis are with us now with greater force. We have short-term interest rates were taken to zero almost instantaneously. It took a while during the 08 period. And the quantitative easing just exploded to the upside.
Sure.
And so we have the same conditions in place that we had at the depths of the global financial crisis. So the idea that the economy has healed itself is a false narrative, in my opinion. And the jobs that have been lost at low wages are probably, to a certain degree, are permanent, I think. And the number of small businesses that have remained closed versus year-end 2019 is still over 20%. And my suspicion is that small businesses are going to fail at a high rate during the winter here. So the chance of a double-dip recession is, I guess qualitatively, I think we're still in recession. My bigger question is, how sustainable, for how long can we go through a budget deficit finance transfer payment scheme and call it economic growth?
Sure.
And the desire to have another stimulus package is very great, but the two sides of the aisle both want to take credit for it and don't want to include the other side. So it'll be interesting to see what happens now. It appears to be a strong probability that the Republicans have retained the Senate. So it'll be interesting to see if we get any sort of a cooperation in response to what appears to be a high likelihood of widespread lockdowns as we speak here. What is today, November 20th?
Yep.
We're talking about curfews in Los Angeles going through at least December, 21st or something like this. And a lot of legislatures are talking about lockdowns. So I would expect to see a narrative developing that we're going to have a soft patch in the economy pretty soon. In fact, many of the economic services that people read, and I read periodically, a lot of them had turned quite copacetic on the economy, as with every weekly gain in the stock market, I would say.
Yeah.
And some of the ones that tend to lean very bullishly are starting to hedge their bets on sort of the green light for the first quarter of 2021. When it comes to the world economy, I find the most fascinating statistic is the guesses by consensus economists on what regions of the world will be growing at. If you look at the entire world, ex-United States, the expected growth for both 2020 and 2021 are significantly higher for ex-US world than for the US itself. And I lay that side by side with the fact that the United States stock market has outperformed many stock markets, not all, but many. Mm-hmm. And it's kind of weird, isn't it, that we have the slower growth forecast and yet a more resilient stock market. I'm sure that's due to the fact that the United States houses these mega powerful, what we call Super Six companies, the big tech, yep. Microsoft, which have driven such a huge percentage of the gains until very recently. Very recently, things appear to be shifting somewhat. And I think that that's curious because I think it's part of a slow-rolling grand narrative that began in the fourth quarter of 2018. When you think of the stock market back in the halcyon days of 2017 when the VIX was living below 10 in a historical fashion, I think the volatility of stocks and risk assets in 2017 was, I don't think it's an exaggeration to say it was unprecedented. And then all of a sudden, we've gone into massive volatility, which has been masked by resiliency, but there's been massive volatility. We had a big bear market in the fourth quarter of 2018 in the stock market in the United States, and then we had a highly volatile recovery, and then we had the quickest fall off into a 20% plus negative return from a record high in history. And then we had a V-shaped stock market recovery for sure, coming all the way back. My suspicion is that the volatility is actually increasing systematically, and it began in the fourth quarter of 2018. So I'm expecting a high degree of volatility in risk assets in 2021.
I think, yeah, it makes a lot of sense. A month or so ago, I think on one of the interviews you were on, you mentioned that people should look away from the U.S. for opportunities, and you mentioned LATAM specifically as that kind of rotation happens, and it's happening this month. I mean, LATAM is one of the top performing parts of the market.
Yeah, I talked about that in my webinars, whatever you want to call them, webcasts, back in, I think one was in June and one was in September timeframe. And I was lucky on the September one because it was almost like the next day the LATAM stuff started to do better. And what's fascinating about that is it is recovering without a renewed down leg in the dollar. Dollar's been stable since August, at least on the Dixie index. And so the Latin America situation probably is benefiting in recent weeks from the optimism about vaccines, because I think Latin America was lagging pretty badly because of the fear about COVID and how long it would go on. But broadly speaking, I am negative on the dollar in a fairly large way for a multi-year horizon. The data that I like to look at is the twin deficits. In these days, the trade deficit's kind of irrelevant because it's not really changing very much. It's actually shrinking a little bit. But the budget deficit overwhelms it, given the size of this stimulus stuff. And the correlation is pretty convincing that the growth in the twin deficits leads the dollar by about 18 months or 2 years. And we've had deficits increasing now for a couple of years, but the real big impulse, of course, was here in 2020, where we've gone to shockingly 16+% growth in the debt versus GDP is where we're standing for the year 2020. And I talked about this in my Just Markets webcast, which I'm sure is still up on replay on the DoubleLine website. Back in the first week of January, I talked about how amazingly weird the starting point was for the deficit situation as we were starting to look recessionary. I mean, I know COVID tipped everything over, but significant indicators were already flashing warning signals that many investors chose to ignore. Things like manufacturing hours worked, things like the leading economic indicators. These things were all flashing warning signals. And yet we were increasing the deficit as we were having positive GDP, which is really not standard fiscal policy, certainly. We don't have a lot of history of that. And I suggested in the Just Markets webcast that in the next recession, that was turned out it was only a couple months away, that we'd have the budget deficit go up to $4 trillion. And it happened instantaneously. And now we're talking about more stimulus. So that's pretty dollar negative. So given the valuations, relative valuations, given the relative economic growth that I referenced, given the stock market capitalization as a percent of GDP is an all-time high in the United States, given corporate indebtedness is an all-time high in the United States, given that the U.S. has outperformed world markets by a very large amount over the last 10 years, the valuation argument for non-U.S. equities, if you couple it with the idea that the dollar is probably going to embark on a significant decline, maybe in late 2021 or 2022, it bodes pretty well for dollar-based investors or US-based investors to start really thinking seriously about non-US types of asset allocations, in equities primarily, I think. And Latin America has already turned the corner on that. Asia was already doing well.
Yep.
And I think particularly in emerging markets, I just think Asia and Southeast Asia are really promising. And for years I've talked about India as a sort of a permanent portfolio position. I think ultimately that will be a huge payoff. So yeah, I mean, everyone likes to talk about, you know, the 10-year yield. They would talk about the Fed, and they talk about the S&P 500, but there's a lot of other stuff that goes on, and a lot of investors have been lulled to sleep because the U.S. has been so dominant over the last decade.
What about, I joke and I call them the boomer stocks, all the value stocks that have been lagging. You know, the growth has been destroying value since like the mid-90s. Finally, after not
Maybe
working.
it's real this time. Maybe it's real this time. Yeah, I mean, that's another one. There's so many things that are extremes that I think you have to be of a mindset looking for a slow rolling change. I mean, you have the CAPE ratio on the S&P. It looks like it's at one of the most elevated levels in history. That just the PE outright, the one that matters, the 12-month trailing, not the one that the pie in the sky, 2 years forward type of stuff that we've started to do. That PE is up at nearly 30. The growth value relationship that you reference, the value of the dollar, the direction of the U.S. economy, all of these things. The value of commodities versus the capitalization of the stock market, the relative performance of energy and financials versus healthcare and tech. These are all at monumental extremes that historically, and that's no guarantee that past will be prologue, but they have historically been intelligent points at which to, as a long-term investor, to make the allocation shift away from all of those things that have been stretched to these remarkable extremes. And that's, I think, is the story that has begun to play out. That's the interesting thing about it. We're not talking about, oh yeah, you said that, you're stopped clock and it's never worked. No, it's been working. Commodities have been performing in the last couple of months. EM is outperforming the last couple of months. Value is outperforming. And what isn't at a new high?
It's all the high flyers.
It's the NASDAQ is not at a new high. And the NASDAQ, of course, was the world leader. It was by far the top sector of the United States.
30% this year.
Yeah, but not just this year, but you're right. Just looking over a multi-year period. And it's interesting that it's now starting to roll over. So the dollar has rolled over. Volatility has stopped being suppressed and is now going higher. Value is starting to outperform. And I believe that that's a harbinger of things to come. The whole idea that the 2016 election was a nutty election now seems quaint, doesn't it?
Yeah.
And I said, I famously picked Trump would be the president even before the nominating process began in 2016. And what I told people that kept saying that I was insane to make that prediction, I said, I'm going to double down on that prediction, tell you that the 2020 election is going to make the 2016 election look normal. And I'm just going to claim that I was right on that prediction. Now that we have this, the violence in the streets that I predicted, the mass population shifts. I was just driving down the 10 freeway, which looks like it belongs in Bangladesh these days. It's in such bad repair. And on the radio, they were talking about mobility trends. And you know what states had the biggest population growth this year relative to their base? Not in terms of raw numbers, but percentages. Wyoming and North Dakota.
Wow.
Yeah. And California.
I would have said Texas or Arizona.
Well, they have a high base to begin with. I think the base effect is a lot there because Wyoming is the least densely populated state in the nation. But North Dakota, whoever thought of moving to North Dakota? But now these things are starting to happen, and I don't think those trends are going to change either. Remember how Silicon Valley and San Francisco real estate was just invincible?
Yeah.
Invincible, right?
Yeah.
Until this year. And now San Francisco County has something like 4 times the listings that they had in the previous 4 calendar years, which were all pretty consistent. And it's just happening en masse. I mean, I've been talking to real estate people, and when you go to the center of the country, the demand for real estate is just off the charts from people leaving. Basically, the realtors say that they're getting easily double the incoming inquiry that they used to get in the last few years, which were good years too. They're getting double the inquiry, and they say it's just about all coming from San Francisco, Los Angeles,
New York,
Chicago,
New
and
Jersey.
New York.
Yeah.
And I don't think that's going to change. So it'll be interesting to see how it changes kind of the society. because when you think about it, if it weren't for the migration that's already happened from California to Nevada and Arizona, I got a feeling Trump would have won the election.
Yeah.
It's kind of strange because it's not like there's more support, like the support has abandoned Trump. I think they've just changed their states, and we haven't rejiggered the electoral system, right? I don't know how often they update the electors, but they certainly don't do it, every year. And what's happened is California is probably going to lose electors, and you're going to have Nevada and Arizona gain electors. But for this one election, those haven't been updated yet.
Yeah.
And so a lot of shifts are going to happen. And you wonder, I have to ask myself, are the people that are fleeing California because of the governance, because of the taxes, because of the decline in infrastructure, are they going to impose the same policies that motivated them to leave California in their new settings? They very well may. It's kind of like, I don't know, they just have they're just kind of wired a certain way, I guess. And they're not looking at the ramifications of their own ideology that has motivated them to leave California. So
some of those places actually don't want the Californians coming anymore. The mayor of Boise, Idaho, ran and won on anti-California immigration.
I can't blame them, because I've never been to Boise, but I have a friend that moved, get this, from San Francisco to Boise about 5 years ago. And he says that in that short window of time, he doesn't quite recognize Boise from 5 years ago. And you wonder what's going to happen with the infrastructure stresses on these destination cities. I haven't been to Austin, Texas in 10 years, more than 10 years now. And
you wouldn't recognize it.
I'm sure I wouldn't recognize it. It was a quaint college town. There, the intersections didn't have traffic lights in many cases. A lot of the stores were tractors and feed.
Yeah.
And I bet if I went there now, I mean, I bet you there's, chai tea shops all over the place.
There definitely is. It's sky rises, but the traffic is terrible.
It's got to be terrible. You can't just have a multiplication of the population and expect the infrastructure to keep up with it. So one thing that's curious is you wonder if the no-tax states or the low-tax states will stay that way. I was in Arizona around Election Day, and I learned that they passed a tax increase from 4.9 to 8%.
It's pretty significant.
That's a pretty significant. Let's just call it 5 to 8, right?
Yeah.
That's about a 60% increase. So, and it's not deductible on the federal levels. And one of the things you have to start thinking about on that is, once you go from essentially a flat tax, I think it wasn't quite flat in Arizona, but it was pretty flat, to one where suddenly you've got a tier that goes from 4.9 to 8, when's the next tier coming?
We've seen it here.
That's what's actually causing the migration creep out of California, at least in part, is 13.3 with not much in return for it, and strong suggestions of 16.8 coming soon, and a proposal of a wealth tax. These are things that I don't think the politicians are aware that the tipping point seems to have been reached. And the migration, somebody told me, you have to fact check this because I'm just repeating what somebody told me. And I've learned over my lifetime not to always trust that, but they said 700,000 people have left California this year.
Wow.
That's a lot.
It's a lot, yeah.
That's like, what is that, what's the population, 40 million?
I think so, yeah.
Something like that.
Yeah.
So you're getting down to a couple percent now. So we'll see what happens. But I think that, broadly speaking, the big picture, and I've been talking about this for at least 10 years, and I said back in 2012 or 2013, I've got good news for you. I don't think this massive trend that's facing us I think it's going to slow down for a few years, and it had to do with demographics and the deficit spending being less onerous from about 2013 to about 2018, 2019. But we're clearly in a situation where the institutions of society and of the economy are out of sync with kind of the organic evolution of the economic processes, which of course were changed in a step function kind of way thanks to the internet and social media. And we're still kind of absorbing that. And the societal changes are leading to a lack of faith in many of the institutions that we have.
Like
And
higher education being one of the
higher
biggest.
education is absolutely up on that list as a top bullet point. But just think about how people think about policing.
They don't want it.
Defund the police.
Yeah.
You know, what are people thinking about rioting, looting? What are people thinking about all manner of religious institutions and everything? And it's that all has to be reset. And I speak in kind of large-scale terms, and a lot of people don't want to believe that. They want to believe that everything will kind of roll along in a way that's comfortable. That happened back in the 1970s, where nothing really changed for a long time. And when I think back on what it was like in the 70s, boy, the economy was way different than it is today. The difference between, you know, a median income and the top quartile, you know, so you break the economic spectrum into quartiles. The difference between the 50th percentile and the 25th percentile was the 50th percentile drove a 2-year-old Chevy, and the 25th percentile drove a new Buick.
Yeah.
That was the economic difference. There was such a commonality of economic experience, and the charts are so abundant and they're so available. Anybody can find them on how that's changed with wealth and income, and it's changed in a way that I don't think is tenable. So this goes back to grand cycle types of thinking, which, as we look at the data points that we referenced on markets, how growth versus value, U.S. versus rest of world, you know, dollar having had a huge run to the upside, and all of those things reversing, I think it corroborates this notion that this big sort of societal reset is coming. And there are very sober thinking people and significant influencers that speak now openly about maybe the U.S. needs to break into two countries. You know, the people that want certain types of policies, progressive policies, and then the people that say, you know, go ahead and defund the police. Go ahead and allow looting and rioting and all of this stuff. Just don't drag me into it. That's kind of the beginning of people wanting to not be in the same country together. I know that's probably some time in the future, but I was talking to an Italian investor, and they were very bemused about the United States and their belief in democracy forever, because in Italy they had democracy back in the Roman Empire for a while, and the attitude, I don't know if this is shared broadly by Italians or Europeans, but they're sort of like, it doesn't last forever. It doesn't. It changes. And the United States, we have a constitution that's pretty old here. It goes back to a very different time, and it hasn't been amended in a long time. It's been reinterpreted a lot of times. But I believe that truly, if we put the Bill of Rights up to a vote, 10 parts of the Bill of Rights, I feel pretty strongly that at least one wouldn't be passed. So the Constitution's getting a little dusty, and you know, maybe we will change things.
Yeah.
So I think large changes are coming. This has been my message, and boy, what's happened since 19 sure looks like we're on track for this type of large reset. It probably comes with significant overhaul to kind of the way people think about organizing and certainly things like the tax code. So we're living in, you know, the old Chinese proverb, you know, may you live in interesting times. That's what was actually sort of a curse.
Yeah, I mean, you definitely see the very different mentality from the younger generation now, and that's going to be the ones they're the ones that will drive the vote, right?
Absolutely.
In the future.
Yeah, I mean,
they're angry because
they're angry because they feel, and I can understand why they feel this way. They feel that the baby boomer generation basically was very self-indulgent and a lot of things got taken care of well for them, like Social Security and stuff like that, and pensions and things like that. And the spending has all gone to the older baby boomers. I read an article in a magazine, it was years ago now, I mean at least 8-10 years ago, that complained about and was raising awareness of the spending on people, and I don't remember exactly the cutoffs, but 65 and over was one of them, versus spending on people, I don't know if it was 25 and below or 18 below, but it's old versus young. The spending on the old was 7 times at the federal level. I'll bet you it's increased since then. And the affordability of homes and the valuation of the stock market, which has created a great investment opportunity for baby boomers, but it's not a great starting point for someone that's 30 years old. I mean, sure, you have a long-term horizon and you can ride it out, but you're not buying at a PE of 12.
Yeah.
And so they have a right to wonder, and the consistent buildup of these excesses, I think, has led to a situation where you have to change it. You can't. It's not self-fixing. You can't pay back $157 trillion of unfunded liabilities in 2020 purchasing power, and that is the number of unfunded liabilities we have in the United States. So, if you think about it, that's something like 7 or 8 times GDP. So, if you're going to actually pay them back in 2020 dollars, you're talking about taking the economy and shrinking it by 10% for generations to come per year. That's just not going to happen. So all these things will ultimately get reflected, and one by one we see kind of the pieces of the puzzle falling into place, that this world interpretation, which has been written about through history by some of the greatest minds of humankind, is it's political philosophy about why is it that suddenly things become destabilized and suddenly you have these either evolutionary or revolutionary changes, rapid evolutionary change or violent revolutionary change. And the best minds, and I've read Karl Marx, which is a name you don't hear much in the financial business because he's viewed as almost the devil himself, but actually Karl Marx was very brilliant, and he wasn't really a communist, believe it or not. The communists co-opted his writings. He actually, late in life, said, if this is communism, then I'm not a communist. But him and, I like to talk about Neil Howe's book, The Fourth Turning, Howe, great read, that speaks about these things too as being cycles of society. And Neil Howe talks about 4 turnings, he calls them. You might call them cycles, he calls them turnings. And the first turning is usually a very optimistic reset that leads to an agreement and a harmony that people are happy and buy into, and it lasts for a while. And then you get to the 4th turning, which in Neil's analysis, and I agree with it, has started, and it will end with these resets coming. And it's a really important viewpoint. And as we see people uprooting their lives, people that lived in California their whole lives and uprooting their lives to move to Austin or Nashville, I mean, the wheel is turning right now.
How are investors supposed to think about preparing for this? I mean, there's some that view all the deficit spending as being deflationary, as the Lacey Hunts of the world.
I think he's right until you cross the Rubicon and truly print money. I think that's right. But what I see here is, again, I'm going to harken back to in 2017, there was no tail risk. We had the lowest volatility year ever, and I think the tail risk is going to land on us in a pretty big way. It's kind of Gundlach's rule of investment physics, if you will, that the frequency of trouble and times the severity of trouble equals a constant. So when you're in a very low volatility environment, it ends up leading to tail risks becoming more likely in the years ahead. So it's kind of like, I like to use the geographical analogy, Death Valley is right next to Mount Whitney. That's not a coincidence, right? The highest point in the lower 48 is right next to the lowest point. That makes sense because all the dirt from Death Valley has to go somewhere to make it the lowest point, and it's going to be right next door. So I think that the low volatility of 2017 will not occur again for years to come, and I think the tail risks are very high. So what you have to do is kind of not make a one tail risk bet. So you've got basically the potential, let's just frame it as a debt deflation, which could happen, and it could lead to a response that quickly pivots you into money printing, hyperinflation. And because you don't know which of those tail risks will be allowed to dominate, you've got to break your portfolio in two and have half of it for the deflation and half of it for the inflation. And I mean, that means that not everything in your portfolio will go up, but I've got news for you. Nothing in your there's never a year where everything in your portfolio goes up, at least not a stretch of years. Yeah. So that's what people always talk about diversification, but the way in which people diversify is often very small-minded diversification. You know, they're going to diversify their stocks with triple C junk bonds. I got news for you, that's not very good diversification. Yeah. They might both work, but it's not good diversification. Where we are now is there is a mutual fund that was quite popular because it did really well somewhere before or after the financial crisis. It was called the Permanent Portfolio. And I'm not really sure who the sponsor was, I just remember the name was the Permanent Portfolio. And all they did was invest 25% in gold, 25% in cash, 25% in long-term government bonds, and 25% in stocks. I actually think that's a good portfolio right now, something along those lines, where you've got deflation, where obviously cash would come in handy, and you've got long-term government bonds, which with their punky yields, they don't sound very good, like not even 1 3/4 on the long bond, but at least it would preserve your purchasing power in deflation, and you would get a capital gain, which would actually give you massive purchasing power in a deflationary scenario. You could easily get a 25% gain, and you could easily have a 10% decline in a debt deflation. You could increase your purchasing power by 35% in that 25% of your portfolio, and then you got the cash. So what's the gold for? Obviously, that's for inflation or for civil unrest, or that might go along with inflation. Almost certainly would. I mean, when you go to money printing, the historical record is pretty much a clean sweep. What ends up happening is the people that were middle class become like the poor were pre-money printing. The poor starve to death, and the people that administer the money printing become fabulously wealthy. Not that they don't experience the inflation too, but they make the money trucks make extra stops at their house. So you end up with ridiculous social unrest. In fact, one of the best examples of that was the French Revolution, where they went off the gold standard due to a debt scenario that's a lot like what the US looks like today in 1773. And time moved more slowly in those days, so the French Revolution didn't start until 1789, but it was 1793 that they were guillotining people in the Place de la Concorde, and beyond that, shooting a lot more people than they guillotined. Why did that happen? Well, it happened because the money printing led to massive famine and starvation, and people were so upset about the situation that they marched in the pouring rain from Paris to Versailles, many of them, I'm sure, with no shoes because of their situation, to basically get the Louis XVI they were going to kill him, but they put him on a cart, and they carted him back to Paris, where he was basically imprisoned until he was beheaded in 1793. That's because people had enough. And money printing would lead to that. So what are stocks for? Well, they're also for a less severe inflationary scenario, because yes, you can add a zero to stocks, you can add a zero to earnings if you have pricing power at the corporate level. So yeah, now in those stocks, I would be advocating that investors, depending upon how much they believe in my dollar view, you would want to have non-US for not just potential lack of a valuation risk, but also the dollar might translate your way if these other currencies appreciate. So meanwhile, we like to think that the buildup of forces in the global society won't lead to big problems, but you look at China, and their GDP was 1/10 that of the United States, 35 years ago, and it's going to pass the United States pretty quickly. And if you think that the relationship between China and the United States is going to continue along the parameters that were put in place in the 90s, I think you're being very naive, because they don't want to be told what to do by an economy that's smaller than theirs. Trust me. I used to go to China every year. I haven't been in a while. I went there about 6 years in a row during the 00s. And just over that 6-year period, the meetings that I had, I met with really senior people, like the deputy head of like the state-owned banks and stuff like that, really senior people. And the attitude that they conveyed changed so radically over that 6 years that it was worth paying attention to. It went from one of sort of a secondary country attitude to one of we're on a par with you, United States. And I know that now it's much, much more in that direction than it was 10 years ago.